What's up? What's up? What's up? What's up? My Mind Your Money business folks. It's me yet again with another video on today's stock market news. And as always, hopefully you're in the market and not trying to time the market because that is simply impossible to do. So let's see what happened today. What did the Feds do? So it says here, the S&P 500 NASDAQ slip as Federal Reserve ushers in first rate cut of 2025. So if rates were cut, what happened in the market? Let us see. Before I even read or go into what happened today, what I believe after being into the stock market on my own for the last few years, I was always confused when something like this would happen, or when stocks turned a profit or companies and the price still went down. When companies gave their earnings report and it was good, maybe one little small bad thing, but overall 90% was a good earnings report. Still, the stock price would go down. And I was like, why is this happening? And then later on, the stock price will go up or would go up. So this is just my opinion. Hearing that the Fed did a cut, which everyone was anticipating, that's monitoring the market, even the economists, right? Because the price went down, they do believe, in my opinion, that it will go up. People will start investing more money now that the interest rates have been cut. So those big time investors, not like us retail investors like myself, who's only investing a small amount of money into the market, but these big investment firms, hedge fund guys who have millions and millions of shares within these companies, I believe they took profit off of the table with the expectation of the price going back up. So when they take profits off the table, of course the stock price goes down, and then more people are going to start buying back into the market. So when they take these profits off of the table, and then next week they can start buying more shares now at a lower price and still have profit sitting in the background to invest in other things, in other stocks, in real estate, in gold, in Bitcoin, however they choose to invest their money or hold it for future investments. So that's what I believe happened today. Money was taken off of the table, not because something's wrong with the market, not that something's wrong with the companies, but they just took profits with the expectations of the price eventually going up on a lot of these companies. So let's get into the news. It says U.S. stocks closed mixed on Wednesday after the Federal Reserve ushered in the first U.S. interest rate cut of 2025. And you would think that's a great thing. Well, it is a great thing. But it says here, Fed officials voted in favor of a 25 basis point reduction, a move highly anticipated by the market. Look, I hadn't even read the article yet, and I said, the market was anticipating this rate cut. Following the central bank's two-day policy meeting, the Dow Jones Industrial Average rose 0.5%, while the S&P 500 dropped 0.1%, and the tech-heavy NASDAQ fell 0.3%. So Fed Chair Jerome Powell said during a press conference that the Fed decision was a risk management cut, as the labor market has been deteriorating against a backdrop of elevated inflation. So there's a lot happening, right? The labor market, that's what you have to, well, not you have to, because I've been researching, listening to different things. There's a lot happening in the background that most people do not see. Like they say, the labor market, inflation. Then you have technology coming online. Like, how is that going to equate in the future when you don't have people creating products, but you will have these AI machines and agents doing the work that humans used to do to help drive the economy? So things are going to be interesting in the future. So I highly advise you guys that are listening to invest not just into the stock market, into gold, into Bitcoin, into silver, but into yourself and learning more information. Knowledge is power. Technology is shifting, and those that do not learn about the shift will be left behind. So when things do take a change and these AI agents, which are these computerized programs, robots, come online and they start replacing things that humans used to do, or they create a new way, a new money revenue stream, how can you benefit from that? Or will you be left out of it and left to fend for yourself, or asking for a handout or government assistance? Because change is coming, and it's not a bad thing. It's evolution. Things always change. I'm quite sure when the railroad system was invented, it sucked for those that used to ride horses and buggies, or those that used to sell buggies and horses. I'm quite sure when the cars were invented, that pissed off the railroad system, because now not as many people are taking the railroad to travel. They're driving cars. Then there was the invention of airplanes. Technology is the same thing. Ice machines. People used to have ice box back in, 1800s. But then there became electricity. So, with the elevation and development of new systems and places and things, those of old will go away. Think about when I was a kid, there was Blockbuster, where you would go in and rent a movie. You don't have to do that now. You can watch Netflix, Amazon Prime, Hulu, Peacock, all those things. So there's a shift happening. So invest in yourselves and invest into learning new things, right? Okay, so in addition to the rate cut, Fed policymakers also signaled 2 more rate cuts this year. A labor market slowdown was expected to convince Fed officials to pivot toward more rate cuts despite an uptick in inflation. The Fed's decision came amid growing concerns over the central bank's independence. White House President While President Trump has lambasted Powell, he may soon be able to exert more direct influence over policymakers. Newly confirmed federal Fed Governor Stephen Miron, nominated by Trump, was the only dissent, wanting a 50 basis point cut instead of 25. That's interesting. Meanwhile, Lisa Cook took part in the policy decision after an appeals court rebuffed Trump's attempt to oust the Fed governor. So on the corporate front, China has told its biggest tech companies, including Alibaba, not to buy the NVIDIA AI chip tailor-made for the country, effectively banning tens of thousands of orders. The Financial Times reported. So that's why NVIDIA's shares dropped 3%. Interesting. Okay, so General Mills' quarterly sales topped estimates, but shares slipped after Cheerios maker warned of challenging consumer backdrop. Also on tap, Cracker Barrel results are in focus following controversy over its now abandoned logo change. Okay, Cracker Barrel. I think I've only eaten there like once. I don't get it, but hey, it is what it is. Yeah, and that's was that it? Yeah, that's it. We got our interest rate cut. So let's see what happened today in the market. Well, Tesla did good again today, gaining $4.24, closing out at $425.86. Palantir lost $1.93 today, closing out at $168.33. Broadcom, lost $13.83 today, closing out at $346.17. NVIDIA, they lost $4.55 today, closing out at $170.29. FTEC, an information technology ETF, lost 94 cents today, closing out at $214.49. Here's an example. when I talk about these ETFs in comparison with stocks, right? You see like how Nvidia lost $4 and 55 cents today, just that single stock. FTEC consists of like 300 information technology companies, not just that one stock. And FTEC only lost 94 cents today. When you average up the gains and the losses of all the information technology stocks that are within that ETF, it averaged out to 94 cents. Vice, a $4.55 loss from that single stock. So that's why it's good to have your money diversified into like an ETF, mutual fund, so on and so forth. So when that one stock or that one company loses a significant amount of money, and that's the only thing that you are 100% invested in, that's a big loss. So you need to diversify your money. And I think if you are a new investor, investing into single stocks is not a wise investment, because when you start seeing these losses, it does something to your brain. Your freaking emotions are all over the place. And when you see these big drops, or you see a drop, you tend to panic and you take your money out of the stock market. And that's never a wise thing to do. However, I mean, the company could go to zero, but that's why you need to diversify your money and have it into something like an S&P 500, like SPLG. Like SPLG today lost only 9 cents. And SPLG is an S&P 500 company, ETF, I mean, that consists of the 500 largest companies in the United States. 500 companies, not just one stock, not just 200 or 300 information technology companies. And some of those 200 to 300 information technology companies that are within FTEC is also within the S&P 500. Nvidia is also a part of the S&P 500. Apple, Meta is also a part of the S&P 500. So when you average out the gains and the losses within the S&P 500, it averaged out to 9 cents. So if you are a new investor, in my opinion, you should be investing into the S&P 500 first and start learning more, investing more of your time into learning about the stock market, how it works. Because if you choose to invest into some of these single stocks, you need to do your research. You need to be tracking these companies, their earnings reports, so you will know when you should and should not invest any of your money, when you should and should not pull out any of your money. Or if it goes up, great. If it goes down, it's not a big deal, because only a portion or a fraction of your monthly or quarterly or weekly investment is going into that single stock. But 50 to 80% of your money that you're investing is going towards an ETF or mutual fund that's widely diversified. And then you don't have to worry about picking the stocks within the S&P 500. You have the managers of those funds doing the picking. If a company is underperforming, they're no longer meeting the standards of the S&P 500 to be a part of the 500 largest companies that's doing very well, the managers will remove that company and replace it with something else. You don't have to do the research and figure it out. They do it for you. So yeah, and on average, like I say all the time, the S&P 500 has brought back at least 10% a year over the last 100 years. So you have to look at the track record of a lot of these companies and understand how it works before you invest, in my opinion. So yeah, but like I said, SPLG, the S&P 500 ETF that I have, lost. Hold on, it went from 9 cents to 10 cents. What happened? Okay, it lost 10 cents today, closing out at $77.56. Okay, I had to refresh. Actually, FTEC lost 76 cents today, closing out at $214.67. Meta, which is a part of the S&P 500, lost $3.28 today, closing out at $775.72. And yeah, that's it. Oh, IVR, the mortgage capital dividend stock, gained 6 cents today. Yeah. closing out at $7.60. So yeah, that's it, people. Like, comment, subscribe, share this video. Let me know what you think, if you think anything at all. Again, invest, people. Invest into yourselves first and foremost. Invest into paper assets that are appreciating in value, which is the stock market. Invest into real estate if you can. Invest into things, again, that are appreciating. If you can afford Bitcoin, invest in Bitcoin. If you can afford gold, buy gold. Only if you can afford it. If you have to put it on a credit card, not so much. Because you need to get out of debt. You need to get out of the personal loan debt. You need to get out of credit card debt. You need to get out of student loan debt. You need to get out of car loan debt. Because as long as you are in debt, you are a slave to whomever lended you the money. You are a slave to the lender, and it sucks, right? And it keeps you from having enough money to take care of what needs to be taken care of at the end of each month. So the way that you get out of debt is by creating a plan. You know, when you're on the job, the bosses give you a plan on the things that you must attack and do in order to maintain your job, in order to get bonuses. So why can't you create a plan for your life so you can start giving yourself bonuses? You know, no one else has to do it. You can do it for yourself and for your family, right? And you can include everybody, including the kids, right? So create a plan, which is called a budget, so you can start telling your money where to go each month. Tally up how much money you have coming in after taxes, and then on the other side, tally up how much money you have going out towards bills, car loans, car insurance, eating out, subscriptions, insurances like car insurance, gas, food, entertainment, all that stuff, right? Coffee, eating out. And if you have more coming out than you do coming in, you need to make it make sense. You may need to cut out eating out. You may need to cut out some of those subscriptions, that gym membership that you no longer, or that you barely attend. Or you may attend, but it's just too much money, right? You may need to start making your own tea and coffee at home. You may need to start eating the groceries that you buy instead of eating out, right? And taking that food in for lunch and breakfast in the morning. You may need to stop shopping as much. Stop putting things like vacations on your credit card. You may need to stop looking like you have more than you do by posting pictures on Instagram or social media as a whole, right? Cut back on those things and start getting rid of this debt. So when you do decide to get out of debt, you need to stop all investments. Yes, I know. Stop all 401k, because you need all access. You need 100% access to all of your money. Don't worry, you will start investing back into your retirement at a later date, but stop all investments. Start tackling all your debt. Once you pay off all of your debt, the car loans, the student loans, the personal loans, now after you've paid off all your bills, you can start investing again. I pretty much follow the Dave Ramsey plan. If you don't know what the plan is, look it up. You can Google it. You can list the Dave channel. That's what I followed when I got out of debt in 2021, paying off $299,000. I know, that's a lot of money. In 27 months and 19 days. I sold a lot of stuff. I got out of my house. I started renting it out, a home that I'd only lived in for 9 months, which was brand new. Started renting it out in 2019, still renting it out. Actually, I just repainted the place because the person that was renting from 2019 just moved out 6 years later, right? So, yeah. And just started throwing everything towards it. And that's also when I start investing into my own brokerage account outside of my my retirement 401k, but I work for the federal government, so I have TSP, right? So, yeah, and it's been great ever since. And I've been living off of my budget that I created back in 2019 since then, even till this day. And I got out of debt in 2021. Anyway, so you pay off all your debt. There's more to it. And if you'd like to know more, you can hit me up. We can talk about it. If not, pay off all your debt in simpler terms. And then once you pay off all of your debt, now you can start investing back into your 401k, your retirement fund. Now you can create 3 to 6 months of living expenses for your emergency fund for emergencies, because life will continue to life. That car may have issues. That hot water heater may go out. There may be a leak in the roof. You may have to go to the hospital, or the kids, so on and so forth. You may need to replace a tire. Anyways, that's what your 3 to 6 months of living expenses is for. You can also start investing into your kids' 529 plan for college. And if that's it, and you only thing left is your mortgage, now you can start chunking away at your mortgage, right? If you don't have a mortgage and you would like to have one, save up to 20% for a down payment and finance that home for 15 years. And more than likely you will pay it off before that 15-year mark. You want to save all that interest payments that you end up paying the bank, because that's how the bank make money. They give you, they don't give you anything. They punch some numbers into a computer and say, hey, here's your $500,000 at this 5% interest rate. And then if you pay that $500,000 over this 30-year period, by the time you pay it off, when you look at your payment, what's it called, amortization plan, you will more than likely pay off a total of $900,000 or close to $1 million from that $500,000 loan over that 30-year period. So, yeah, you can look it up. Finance for 15 years. Because you've been paying off your debt, you will more than likely be gazelle intense, that's what Dave says, when it comes to now tackling and getting rid of your mortgage, because you just don't want anything to do with debt. And then after your home is paid off, you do whatever you want to do. You no longer need to think about putting your vacation on a credit card. Vacations are something that shouldn't just happen at spur of the moment. This should be planned for. If you're planning for things, then you need to allocate a certain budget and money towards that event so you can pay for it cash, right? And that's it, because I've been talking too much and I need to go to work. All right, so as I said before, like, comment, subscribe, share this video. Let me know what you think. If you think anything at all. All right, so you guys take care. Have a blessed day. Peace.